Hi, John Griswold here with Griswold Group. Excited to fill you in on what's going on with housing in San Diego. So there's been a lot of volatility over the last couple of months. And really the thing that seems to be the most powerful in terms of changing interest rates up or down has been jobs. So jobs came out where unemployment was higher than we thought, and that really dropped interest rates down to almost 6%. I think they bottomed out about 6.1%. And we saw an immediate reaction from the real estate market. Demand really increased. The amount of new finances really increased from lending. And we started to see more multiple offers, just more demand in general, expected market time, the amount of time it takes to actually sell a house from when you put the for sale sign in the front yard to when you market pending, really decreased. And so the problem though was that we only had rates that low for about a week. And the reason for that is that, again, jobs. So as we were having this precipitous fall in rates, we then started getting a bunch of other jobs data that didn't support that the economy was cooling. And so we had, unemployment was way lower than it was supposed to be. We were, and we ended up hiring like twice as many people as was forecast. And so then we had rates go right back up. Even as the Fed did their 0.5 point cut, we actually had rates go up as the Fed was cutting. So it's a bit frustrating for folks in the real estate industry who are seeing the benefits of having those rates closer to 6%. But right now we're right back up to around 7%. And so unfortunately that has really cooled demand in San Diego. Some of that is cyclical because we're heading into the slowest part of the year, but most of it is just price driven. And so what we're seeing right now is that expected market time is back up to just over 80 days on average for the county. So pricing is really important. How the home looks is super important right now. And it's going to take a little bit longer to find a buyer when those buyers are having to factor in interest rates closer to 7%. So that is the climate right now. And the higher up you go in price, the more exaggerated that supply and demand imbalance becomes. So north of 4 million, for example, like super luxury in San Diego, I wouldn't be putting a home on the market right now. I'd be waiting until the spring because there is just not a lot of buyers in the market relative to how much inventory there is north of 4 million. So as you go lower in price, it starts to get a little bit more competitive, more like a neutral market. Most of San Diego is sort of like a neutral market right now. Just a month ago, it wasn't. I mean, I've got deals closing right now with multiple offers on them, and I don't know if those same deals would be in such an advantageous position for a seller if we had delayed just the 30 days. So some of that is just luck and timing and how things are going. So if you're trying to figure out where the markets are headed, the thing to really look at as you're looking through your Google News feed is anything about jobs. And as I'm filming this on Halloween, tomorrow is Jobs Friday. It's going to be a big indicator of where we're headed. If we're seeing that unemployment is rising, then that's going to put a lot of downward pressure on rates. If we miss that mark and the economy is doing better than we think, it might stay the same or potentially go higher. So most people are feeling like we're heading into a much better interest rate climate as we're heading into 2025. That has nothing to do with the election, by the way. It has everything to do with jobs data and where we are with inflation. So I hope that's helpful, and I'll talk to you on the next one.